I am Melissa George, founder and CEO of Invest Her Fiduciary Solutions. I will have Sarah to introduce herself.
Hi, everyone. I'm Sarah Hanson, and I am a financial planner with Investor Fiduciary Solutions.
And we are so excited today. We have our very first guest, a very special guest. We have Kerby Wallick, Chief Investment Strategist for Streamsong Advisors. And I'm going to have Kerby to introduce himself, but just to give you a little bit of background, Kerby and Streamsong Advisors are our strategic partner here at Investor Fiduciary Solutions. So all of our clients know Kerby quite well. So we want to introduce him to the world and ask some questions that most people don't ever get an opportunity to ask a portfolio manager. So I believe strongly that investors make better decisions when they understand how portfolios are crafted, how they're managed, and how professionals like yourself, Kerby, think about markets. And so that's going to be the purpose of today's conversation. But
Sure.
first, tell us a little bit about yourself for our viewers.
Well, thanks, Melissa and Sarah. Thanks for letting me join you on this. As Melissa mentioned, our firms work together really at the hip, very strategically. Sarah and Melissa do a great job of the financial plan and the overall big picture, and I'm kind of the nerd behind the curtain that runs the money, right? And so um, very blessed to get to do that. It's something I've been doing for 35-ish years and love doing it. So uh, thanks for having me on, guys.
Absolutely. So, Kerby, most people have not heard of Stream Song Advisors. And so,
hmm
can you give us a brief overview of the firm and its approach to portfolio management?
Absolutely. Uh, I spent most of my career in large regional banks. Some of the names that you would think of, regionally, largely in a portfolio management role, in a client-facing role. What started to bother me as I got older in my career was that I was not incented to do a great job for clients. I was incented purely to bring in new business. Put somebody in a model, forget about it, run out and help the salesperson sell something.
Mhm.
And that really, number one, it started to bother me professionally, but number two, I just felt like clients deserve better, right?
Mm.
I mean, and at one point I had over $1 billion under my management, but I had 700 clients, right? So, if the client didn't call me that day, I probably didn't look at his portfolio that day.
Right.
And if they did call me, I was probably out on a sales call anyway. So I'll get back to you. So a mutual friend introduced me to Tom Braun, who was at the time also at a regional bank, but thinking about pulling a team with him to start his own registered investment advisory firm. And um, oddly, the person that introduced us was going to be Tom's CFA. He was portfolio manager.
Mm.
He got cold feet and entered and said, "Hey, I'm not coming, but I got a guy." And so he introduced Tom and I. My first question was, "Tom, what's my sales goal?" And he said, "Zero." He said, "You stay back and run the money. I'll go out and develop the relationships." And then subsequently, a couple of years later, we met Melissa, and she also became, um, you know, filled that role for us of developing relationships and doing the planning. And I get to be the guy that sits and studies spreadsheets and charts, and I just couldn't be happier. So, yeah, it's been 11 years now, almost, well, 11 and a half, and it's been the best 11 of my career. It really
That's
has.
fantastic. Now, while you were talking, you mentioned a registered investment advisory firm, which both of our
Right,
companies are RIA firms, but I'm sure a lot of people don't know what that means.
right.
so, so tell us what an RIA firm is.
Yeah, so an RIA firm is an investment advisor that's registered either with the state or with the Securities and Exchange Commission, the SEC. And in fact, at Streamsong, we just crossed over that threshold. So yes, right. We're now registered with the SEC. because we've grown, our asset size to the point where there are regulators now, and by regulators I mean that very sincerely. They make sure that we're doing the best job we can for the clients, and most importantly, as a fiduciary, we're putting the client's needs first.
Yes.
Right. So if you see an investment in one of our portfolios, it's because we believe that investment has a role in that portfolio, and not that, that we get paid any extra revenue sharing or whatever to have that investment in there. So that was a really important thing for me, to make sure that, we maintain our objectivity, and do the best job we can, and always put the client first.
That's excellent. And I want to say, Kerby, that when I was looking to partner with a portfolio management firm, that was super, super important to me. The reason why my firm is, I should say our firm, me and Sarah, the reason why our firm is also an RIA firm is because we really believe in the fiduciary standard of putting the client's interest first. So thank you for sharing that. This next question is really important, and I'm going to turn it over to Sarah, let her ask a couple of questions as well. So you are a chartered financial analyst. You're a CFA. Correct. And I know very often when I'm talking to Tom is like, well, that's like a PhD in investing, right? Tell us a little bit more about what a CFA is. I know it is probably one of the hardest exams to pass, but tell us a little bit more about what that means.
Sure. And back when I was, at an early stage in my career, I talked to a mentor and I said, should I get an MBA or a CFA? And he said, well, if you don't know exactly what you want to do, get an MBA. It's very broad, right? If you know you want to be in investment management, get the CFA, because it is a deep dive into portfolio management, security valuation, economics, regulations, and so forth. And it's really, I couldn't tell you anything about marketing, but, I can go a mile deep in the investment management world, whether that's, constructing a portfolio or analyzing stocks or whatever. The CFA program, back when I took it, and it's still a 3-level program. The first level is a very broad subject matter that make sure that you can handle what's coming next, and so you have to pass that level to go on to the next level. And back when I was taking it, they always said that was more of a generalist. Then the second level is more tearing apart balance sheets and evaluating securities and understanding economic models and so forth, and so that in that segment are where a lot of the accounting and a lot of the analysts did well, right? Because you really had to know your accounting rules. If you pass that, you go on to level 3, which I think they've changed now, where you have to even specialize a little further, but it was more portfolio construction, right? How do securities react with one another? How do you build diversification? And number one, you want diversification, and how do you achieve that based on some of the statistics of how do these securities react to one another, and are they driven by the same thing, or are what's their correlation and so forth. So portfolio managers tended to do better on level 3, which to me was great. At the time we had just moved to Michigan from Ohio. We had our second baby had just been born, and I was studying at night. So it was I was blessed that, okay, I at least speak the language, right? So, and it used to be you would take each level of the first Saturday in June, and then you had the summer off because you didn't know what level you had to study the next year. And then sometime around September, you got the letter from the Chartered Financial, the Institute. And it said, as a friend of mine said, it either started with a W or a C. If it was a W, it was a "we regret" to inform you, right? And if it was a C, it was "congratulations, you're moving on." And so then about December, you start studying for the next level. Now they've added different dates that they offer the exam now. I think these kids have gotten kind of soft. But having said that, though, the pass rate has continued to drop. It's I think 25% of the people that start finish it in 3 years. And 40% of the people that take any one level pass it. So it's a difficult exam, and some would argue too difficult. I mean, it's gotten a little bit of a Trivial Pursuit feel to it versus testing that body of knowledge, but it's certainly rigorous, and it's once you've got it, you want to continue to make it harder, right? I'm in the treehouse, pull up the ladder, so let's make this thing tougher. So it really has. It's been a valuable tool for me, a valuable base of understanding and knowledge, and it's something that I'm very grateful to have been able to pass in 3 straight years. I should point out.
Okay. Thank you for sharing that. Because I know a lot of times people see the alphabet soup behind our names. Yeah. They don't know what all this stuff means. You got to go look it up. And even there's some initials that I see that I literally have to go look up. And I actually went on the FINRA website. FINRA, for those, most people don't know what that is either. They are the regulators for the securities industry, and they have a whole list of what all the alphabets mean.
Okay.
Up. But I want to turn it over to Sarah. Let Sarah ask a couple of questions in here as well.
Yeah, thank you, Melissa, and thank you, Kerby. Yeah, that's important information to know, especially someone who, like me, just graduated with my master's in financial planning, and we're looking at which designation should we get. That's something they tell us to start thinking about.
Right.
And for you to, explain how rigorous it is, it's something to consider. I mean, definitely, especially if you have young children, work a full-time job. I mean, that's a lot of studying.
It was. They say it's 200 hours per level.
Mm-hmm.
And I'd say that's about right. I think I had to put more than that in the second level because because it was more accounting and more statistical analysis. And although I am a proud alumni of the University of Akron, go Zips, I hadn't dived that deeply into the accounting yet. So I probably put more than the 200 in on the second level.
Wow. Well, thank you again for going over that. That's very important information. The next question I wanted to ask you was, over your career, what experiences or market cycles shaped your investment philosophy?
Well, that's a great question, Sarah. And I think back when I first became interested in the money management business, right? And so Melissa's heard me say this 100 times, but my dad is the kind of guy that can fix and build anything, right? Very mechanical minded, very, very good with mechanics and and with his hands and stuff. I didn't get any of that, right? I go to Valvoline to get my oil changed. So I figured out pretty early on that I'd better learn how to add value and to make a living by thinking and analyzing and I just wasn't going to be a carpenter or a mechanic, or just couldn't. I didn't have the skills.
Right.
So at that time, I started looking around and said, okay, what does that mean? And I did a report on the stock market and fell in love. I was like, this is it, right? If I can analyze things, create wealth for clients and for myself, and this is what I want to do. And so went to school, got my designation, or got my degree. Then at that time, I thought, well, that means you got to be a stockbroker, right? So joined a great firm right out of college, went through their training, got the exam, got all the licensing done, got back and said, great, I'm ready to start managing money. Where is it? And they said, it's in your phone. Have at it. And I was terrible. I still have PTSD on talking on the phone. But one of my first experiences was I was leading with a specific security and selling that stock. Right. It was and I still remember JBM was the symbol. I remember it, or JBM. Yeah. Jan Bell Marketing. They were a company that if you go into a Kmart, if you can find one anymore, but any of the others, a lot of times the jewelry department isn't Kmart. There isn't one. It's somebody is renting that space, right, to sell jewelry within. And Jan Bell Marketing at that time was the provider for Kmart.
Okay.
And we're just growing like crazy. So I'm cold calling with this thing. I've got all my family and friends and any client that I could possibly accumulate in this stock. And it was doing well until they found out that they were cooking the books.
Oh.
And it imploded. Right. So, and I was sick, literally sick at my stomach. And I've heard that you're not a real doctor until you kill somebody. Well, in my mind, you weren't a real portfolio manager until you blew something up. And it just, it was. And that's when I said, you know what, I need to get serious about portfolio management, not selling stocks. Yeah. And that's when I really started to understand, you can pick one or two stocks or one or two cyber or one or two cryptocurrencies, and you may make some money at it, but that's not portfolio management, it's gambling. Yeah. Right. So that was a lesson that still sticks out to me, and one that some of my family still brings up occasionally at Thanksgiving. Hey, what was that stock you had us in? I don't remember. Right.
I just want to thank you for sharing that, because it takes a lot of courage to be in this industry and to make a mistake and to stay the course. Like, we learn a lot from our mistakes. I think about things that I didn't know early on in the business that I know now. And those of us that are willing to stay and learn and, apologize for the things we did. Right. But once we learn, our clients going forward are better for it. So thank you for sharing that, because a lot of times people are not willing to share the things that may have been a mistake, but also the thing that shaped them, right, to who they are today.
Yep.
Yeah. Thank you so much.
Yeah. So, yeah. And that started my journey. Then I left the brokerage firm and went to a small bank there in the community we were in that had a trust department, a wealth management department, where, you could actually manage portfolios. You could, they were diversified. They were, they were much more investment management than speculation. So that one still haunts me. Right?
I did have a question about that. What you said in your story about cooking the books. What does that mean?
So they were lying. It was fraud. They were booking things as revenue that weren't. And I forget all the details, but people went to jail over it. But that didn't recover any of my clients' money that had evaporated when all of a sudden you couldn't trust management, right? Their reporting was skeptical at best. And so the stock just plummeted, and there just wasn't anything you could do. It was, there have been a couple of times in my career, you hear about the Enrons and so forth. Those of us that have been in the business long enough have lived through that, that it was a great company. I shouldn't say a great company, but a very broadly owned company. Right. And even in diversified portfolios, you owned Enron because they had a great, revenue growth and so forth, but it was fabricated. It wasn't true. So.
Okay.
It's interesting you brought that up because sometimes we, we talk about WorldComs and then we also talk about, was it MCI?
It's
And
another one.
um,
Yeah.
I, I have watched every documentary and show there is about Bernie Madoff, and I happened to be watching in this past week. And your heart breaks for the people that invested their life savings, and
It
now that
does.
30
Yep.
years he was cooking the books as well, right? The
Right.
big
Right.
Ponzi scheme in American history.
Mhm.
But
Yep.
it's an even better reason for us and to be more diligent about, again, the fiduciary standard and the diversification, right?
Absolutely.
What I thought was a little bit interesting about Bernie Madoff, not to really sidetrack, but I think this is an important part. When they were going through it, they were talking about the statements that he sent out. They were the
Exactly.
dot matrix printer
Yep.
with no phone number or anything. Like if you wanted to call, no online anything where clients could go and look at their portfolio. Not to say that
Right.
couldn't be fabricated either, but for that day and
Right.
time,
Yeah. That was
are we on
crazy.
the dot
And
matrix? Yeah.
yeah. Yeah. And to have people that, I mean, it was purely, and so that's one of the reasons, by the way, that we don't custody any of our assets. We use, in this case, we use Charles Schwab. All of our clients have accounts at Schwab, and so their statements are coming from Schwab. They have a 1-800 number if they have a problem with logging in. They go onto the Schwab website. It's not StreamSong Advisors or InvestHer. It's Schwab,
Yeah.
right? And the way I describe it to clients is it's kind of like one of those, if you see the movies where they've got the clean rooms, right, where you've got this box that something is inside of, and you can put your hands in the gloves that go into the box, and you can manipulate the thing in the box, but the only person with a key to the box is the client. And so that is, if I were looking for a money manager, I mean, it's one of the first things you ask is who's your custodian and where are the assets held? And if it is, oh, we hold them, that's a red flag, right? But Bernie did such a I don't know if it was an amazing job, but he convinced people that his returns were that good.
And
And if you just
never,
did
never.
ever, I mean, and you couldn't have created the trades that he was supposed to have done. There wasn't even that volume that day, right? And so, yeah, he was creating the statements, printing the returns. So, yeah, and again, as a fiduciary, that's why we want to safeguard
Yeah.
everything. We may pick a stock that goes down, but it's going to be a stock inside of a larger portfolio of stocks. And even if all of them go down for a little while, they're not going away, right? And they're not fabricated. And that really, to me, is one of the things that being a fiduciary is so important, and being regulated and having a fortress company like Schwab hold our clients' assets. I mean, Melissa, I've heard you say it to clients too. If something happens to us, their money's still their money, and it's still at Schwab.
Yeah. I think. Oh, I'm sorry, Sarah. I just wanted to make this other small point. Out of that, there was, the SEC got raked across the coals because there were whistleblowers for years, and
Right.
to find out all the things that they missed. Like,
Right.
people weren't just upset with Bernie Madoff's company. They were upset with the SEC because they were supposed to be protecting the interests of the consumer.
Mhm.
So many
Correct.
things changed and came out of that. Even now, when we think about it, the Department of Labor wants to move the whole industry to the fiduciary standard, which is the highest standard that there is. So much of
Right.
our industry is still under the suitability standard, which is the minimum standard, right? And so this is a conversation I have with a lot of clients or prospects, if you will, that there is a difference, and for them to understand what the difference is. So when they are thinking about whether it's portfolio management, of getting a financial planner, an advisor, but that's one of the questions they should ask is that, are you a fiduciary or are you just under the
Yeah.
suitability standard? It makes a significant difference.
It sure does. That's a great point. It sure does.
Well, speaking of StreamSong and Investor being fiduciaries, and talking about other companies that have done the wrong things to clients, how does StreamSong, how do you and your team approach diversification, risk management, and portfolio construction for long-term investors?
Probably the most important question out there for clients, right? There's one rule in investing that just simply can't be broken, and that's that risk and potential return go hand in hand, right? If somebody's telling you that this investment's going to get 3 times your money in a year, and there's no risk, they're either lying or they're stupid, and neither of which is a good characteristic for a portfolio manager. So the first thing that we do is we make sure that we can build that diversification, spread your risk out, right? So our first conversations with clients, we're trying to determine what's appropriate asset allocation for them. How much should be in stocks versus bonds versus alternatives versus cash. Once we've got that decision made, and so that's your first level of diversification, then we want to diversify among those asset classes, right? And so even among stocks, we want to own different kinds of stocks in different sectors, energy stocks, technology stocks, bank stocks, you name it. We always want to spread out. We don't want them all marching in tandem. And then, so to do that, as we start building smaller portfolios, if we don't feel like we can get the diversification that we'd like with individual securities, we'll use exchange traded funds, or ETFs, which are really just baskets of something. So for example, one of the themes that we really like right now is the build out of the power grid, right? As we knew, AI or EV or whatever it is going to need more electricity, more power. So there has to be investments in that power grid. So we like that as a theme. If a portfolio, if we can't buy enough, a couple different stocks in that theme, there's actually an ETF out there that focuses on that type of stock. So we'll buy that for that client. So instead of one stock, they own 30 within that one basket. And then we'll diversify the baskets, right? We'll have some small cap stocks. We'll have some international stocks. We'll have some value stocks, some growth stocks. But again, spreading that risk out as much as we can is really important. It's interesting, one of the indexes that gets quoted and followed quite a bit is the S&P 500, right? I mean, a lot of times when people say the market, that's what they mean, which is, it's the 500 quote unquote biggest stocks in the U.S. Tweaked a little bit by Standard & Poor's, but because the AI trade has been so popular in the last couple of years, that index has gotten really heavily weighted in what people refer to as the Magnificent Seven, or the Mag 7. And at one point, 9% of that S&P 500 index, which is an index of 500 stocks, 9% was in NVIDIA, one stock. To me, that's not diversified, right? I get twitchy at about 5%, and at 10, I'm absolutely sweating, And so you really want to limit your risk as much as you can through diversification, and I think some of that is coming off of the market now, as some of those stocks have sold off, but still, so that's how we build diversification at the start. As the portfolio grows, if the portfolio starts with larger dollars and we can get individual securities, we're going to do that more quickly than perhaps others. But again, we're always going to be diversified. We won't, at a minimum, we're going to own 30 stocks and not two, right? And unlike the Jan Bell marketing experience where I had one and it didn't work. And so, yeah, that's one of the pieces of being a fiduciary is the prudent man rule, right? You invest as a prudent man would under the existing conditions. And to me, that's being very prudent. And that underlies everything we do is that prudence.
Okay. Thank you, Kerby. Yeah. And I think the other thing I like about StreamSong is that it's very individualized.
It is.
And, clients can customize it and they can work with you to invest in things they really value. And
that's right.
I think that's important for, younger investors too, because I feel like we're trying to save the world. And, so we're very passionate about different, specific companies. So I think StreamSong does a really good job at working, especially you do a really good job at working with the clients one-on-one. And yeah.
Yep. Well, thank you. I appreciate that. And it's gotten, your generation's voice has been heard, right? And it's forced a change in our industry. It didn't used to be, the ESG or environmental, social, and governance scoring and using that as a data point didn't exist until your generation spoke up and said, hang on a minute, I'm not comfortable owning XYZ because they're terrible. They treat their employees terribly. They treat the environment terribly. I don't want to own it. And so the industry heard that loudly, and now we can actually screen for those scores, and build portfolios out of that. There are also exchange traded funds or ETFs that only use that as their score. So yeah, absolutely. And the other thing that we can do is, customize around, we may have a client, for example, one of the stocks that's really gotten hit earlier so far this year has been in the software industry. All the software stocks have gotten thrown out, and we think that creates some opportunities in some, in particular, we like Salesforce right now. So we've bought Salesforce for many, many clients. However, we have an executive, a client who's an executive at Salesforce. The last thing she needs is more Salesforce.
Yeah.
So we can build around, that way too. Whereas if we were just, sticking people into models, you look like a model B to me. Bam, there you go. You get what you get. And it was really important to me, and I'm really thrilled with now that we're 11 and a half years in, we've built that for clients is that ability to be thoughtful and customized. And, even as we grow, we really want to still feel like and act like a small boutique investment firm.
Yeah.
I wanted to add something to that, Kerby. I think it's interesting that you brought up the models, because we don't use any models. And that type of passive investing, I mean, that's great for, people that are kind of like do-it-yourselfers, and they just say, hey, I just want to see everything in the S&P. But a lot of people have passive investing, but they're still paying. They're paying for full portfolio management, and they're not getting it. And so I just wanted to bring that up as a point. One of the things that I also is very interesting that I thought was definitely a part of the reason why I wanted to partner with StreamSong is firms that I worked at previously before I started my own. I could not even talk to the portfolio manager unless my client had $1 million plus $2 million in investable assets. investments. And so one of the things that was unique, that we don't open any account, no matter what size it is, until we have an introduction to you, right? I make sure that every single client gets to meet you, gets to talk to you. We talk to them very specifically about how their portfolio is going to be invested. They get your email address, they get your telephone number. We talk about how we all work together. That is significant. I have not seen that anywhere else. So that is unique to StreamSong Advisors and IFS, Investor Fiduciary Solutions. So that's one of the reasons why I wanted to have you on here. Most people may never get to speak to a portfolio manager.
Yeah.
Your background, having worked at regional banks, having managed mutual funds, and now creating these customized portfolios for all of our clients is significant.
Yeah, well, I appreciate that, and it's actually a part of my job that I really do enjoy and cherish. It's, when I started, got the offer to co-manage a mutual fund some years ago, I thought I had my dream job. Right, I could manage one portfolio and sit in my office 10 hours a day reading research reports. And as much as I say I love that investment nerdy stuff, it wasn't too long until I came out like somebody that's been in the basement for too long and was just like, I got to talk to somebody. I can't. Right. So it's still a part of the job that I really, really enjoy and love hearing the feedback from clients, and whether good or bad, fortunately, most of it, we get good feedback. And I love the questions that some clients will ask. Why did we do this? What role in the portfolio does this asset have? And I'll talk about that all day.
Right? Yeah. So that makes me think, and I may get these companies wrong, but I remember asking you about this not too long ago, where I was reading an article where between these three companies, they're all basically purchasing from the other company. And I know NVIDIA is one of them. Yes. Is it Oracle or Microsoft? Right. They're just all kind of, NVIDIA is buying from Microsoft, is buying from Oracle, is buying from NVIDIA. So it's just like a circular thing. Can you speak to that a little bit?
I can, and it's something that didn't matter until it did, right? And so we use the analogy of, I don't know if you've seen the Three Stooges skit where, Larry owes Moe $10 and he pays him, and Curly says, hey, wait, you owe me $20. Well, here's 10 and I'll pay you back the rest. And, and then Moe says, well, wait a minute, you owe me $10. So it's the same $10. It just goes around and everybody's happy. Right. So some of that's okay. The cross revenue, but it certainly then calls into question, okay, what multiple are we applying to those revenues to justify the stock price?
Right.
Stock prices are simply a multiple of something, right? Whether it's a multiple of earnings or cash flow or revenue or dividends or whatever. Stock prices are often based on something and then applying a multiple to that something. And so to me, it means that once you understand that circular revenue cycle, I think you have to say, I'm not willing to pay as high a multiple for that revenue because it's sketchy. I shouldn't say sketchy, but it's certainly got an asterisk on it. So, and I think that's what we've seen some of this year is you've seen some of those multiples come down based on that fear that, have we paid too much for this same dollar being passed around? And yeah, maybe, but so markets always swing, right, from one extreme to the other. So there will be a time when any sell-off goes too far and it creates opportunities to buy stocks that you've wanted to buy for a long time, but they were too expensive. Now you can do it. And so right now we're a little skeptical on the market just because of all the headwinds, but we still like it for the long term. And so we've And one of the things that we do too at StreamSong that's a little different is once we establish your long-term target, we'll put tactical ranges around that. So for example, many of our clients have a target of 60% in stocks. Well, we'll build a range around that and say, okay, we'll go up to 70 or down to 50, depending on what we think, should we be opportunistic or defensive right now? And right now we're a little defensive, right? So that was the other thing I wanted to do at StreamSong was to have the ability to be tactical with portfolios. Certainly not, and with the volatility that we've had, there's that inclination or that desire to do something, right? And a lot of times individual investors do themselves no favor by doing too much of something, right? They'll say, I need to get out of the market. Well, no, you might need to bring your allocation down because there's some turmoil coming, but we never want to go all in or all out, right? We want to manage around the edges. And as an example, I think of, when we went through COVID, right? And the market went down. And I don't say we saw it coming, but certainly felt like there was some turbulence coming. So we had reduced equity exposure in portfolios. And then when the market really looked like it had gotten oversold, we started to rebuild that equity allocation. I said to my partner, Tom, I said, normally managing a portfolio is like flying a jumbo jet. You set your target, turn it on, and then you make some tactical adjustments for the weather along the way. And that's normally what it's like. I said, but now, man, it's like flying a fighter jet. I said, I'm dipping and dodging, buying and selling. And he brought me down to earth and said, you are nowhere near cool enough to call yourself a fighter pilot. But it's still a lot of work, and I enjoy it. So yeah, that's what Tom and I are good at, that bringing each other back to earth when the ego gets a little too big.
So you mentioned one common mistake that investors make when the markets are volatile. What other common mistakes do you normally see during volatility or uncertainty in the markets?
Yeah, I think that's the main thing, and that's why we really encourage investors to, yes, we'll make some tactical adjustment, but never get all out or never try and go, because then you got to get two decisions right. You got to get, when do I sell and when do I buy, right? And generally the time to buy is when it feels terrible to buy, and the time to sell is when it feels really easy to buy, right? Because it's then everybody's buying, and so I think that's the main mistake people make, is trying to do too much to adjust to volatility. What we've done is we prefer to bring down the overall risk, but at the same time, don't close your eyes to opportunities that are popping up. As things get oversold, take advantage of those. And so I think that's the biggest mistake individual investors make is trying to be all in or all out. And that's, you're gonna sell at the wrong time, and you're gonna buy at the wrong time. Yeah.
So I have a question about AI.
Okay.
I probably could have asked you this question a few years ago about crypto, probably similar type of thing,
Right.
but AI is really dominating the headlines right now. From an investment perspective, how do you really separate the real long-term opportunities from the hype?
And that's become the question of this year that we've seen, is that people are going, oh, wait a minute, maybe this isn't the panacea that we think. Or the unicorn that everybody thinks. I think it's going to be, I think now we're looking at, okay, number one, yes, we're still going to have to build out that infrastructure. Number two, the reality of it is we don't have the power to make it happen right now. So to us, that's the next derivative of where to invest is who's building out the power, who owns the power. Um, is AI going to? I read an article, and you may have seen the same one, where somebody said it's not going to be AI that takes your job. It's someone that uses AI that will take your job. And from an investment standpoint, we've had to get back to some of the fundamentals and say, hold on a second, how much are we paying for this revenue? How much are we paying for these earnings? And how far out are we projecting these things? And for that reason, starting about mid last year, we started really paring back our AI trade and looking at other stocks that, what companies can use AI to improve their margins, and to their benefit, but it's not a straight AI. Now, having said that, we own NVIDIA. We think they've got a great product that's going to be. There's a lot of use cases for it. We own Microsoft, but we don't use a lot of the some of the latest and greatest AI companies. And people say, is this like the .com era? I don't think so, but it rhymes. And when some of these valuations start to matter again, they're going to matter in a big way. And the thing that worries me most about the AI trade is how much it's impacted the overall indexes. So people that just think they've got an overall S&P 500, I'm very diversified. Unfortunately, you're not. About 40% of your portfolio is made up of the top 5 or 6 companies. So,
S&P is also a growth and income index. What about, small cap? What about international? What about
exactly?
ICC, right?
Yeah, that's exactly right. Yeah. And so we've been more interested in, we bought some of the software stocks that got sold off, but we bought Del Monte Fruit. How unsexy can you be? But they sell a lot of pineapples, as it turns out, and it's a pretty attractively valued company. So it always comes back to the fundamentals, and we always want to, as Wayne Gretzky always said, we try and skate to where the puck is going, right? And so that's where we're trying to be ahead of that next trade.
Well, here's one question that I haven't asked you all, and it is about AI, because Sarah and I do both use AI. My AI is called Sage, and hers is Clara. I wanted to bring this up for a very specific reason, because while I absolutely love AI, I'm also equally skeptical. And so I think it's important for clients to know that I don't put any of their personal information in AI ever, right? What we use for, and I want you to share, maybe how you all are using it at StreamSong. I use it for clarity. I use it for project management. I'm writing a book right now, and Sage put a whole project plan together for me to help me get my book written, to basically pull the book out of me. Like, here's what you should be doing in week 1, week 2, week 3, things like that. For sometimes evaluating an agreement that I'm putting together. But I don't put client information in AI ever. I wanted to ask you, how is StreamSong using AI at a personal level, like at a business level, as opposed to buying AI stocks?
Yep. So a couple of ways. One, we've used it, and I'll admit, having done this for as long as I have, sometimes I need to be dragged kicking and screaming into a new technology, right? But fortunately, we have some younger guys here that are learning the trade, that know this AI stuff great, right? So one of the things that I've done over the years is particularly when there's some kind of market volatility, we'll send out a communication to clients that say, hey, here's what we're seeing, here's what we're thinking, here's what we're doing, just so they know we're on it, right? And we're thinking about it. I used to do that all from scratch, right? I'd write it all. I mean, not as bad as you can see me on an old typewriter clicking away, but I wrote the whole thing, and then had partners and trusted friends edit it and so forth. Lately, I've written, and I'm egotistical enough to think they're pretty good, right? And so, um, about a year ago, we started the process of I'll write it, and then the young guys will run it through an AI.
Okay.
And I had to swallow my ego and say, that's pretty good. Right? That it said what I wanted to say, but
In
in
10 seconds.
a much smoother fashion.
Yeah.
Right. So that's one way we've done it is in client communication. The other way is in research. It has sped up our capabilities in researching individual investments immensely. We subscribe to a software or a program that I'll type in a ticker and it'll pull up everybody's research on it and scrape it and summarize it. And it'll say, here's the consensus, here's what the most negative people are saying, here's what the most positive people are saying. And it used to take us days, to go through and read everybody's. Now we can do it in an hour, and really get a pretty deep, and then you start asking questions, right, and deep dive into it. And so we've used it certainly on the research and on the communication side. I don't see us ever turning portfolio management over to an AI. I just don't. And because I think that's dangerous. I mean, if everybody's using the same model, everybody gets the same answer.
Right.
And so you saw that back in the real estate crisis, the financial crisis. Everybody was buying these mortgage-backed securities because they were all using the same model to value. Well, as Mark Twain once said, it's not what you don't know that'll get you; it's what you know for sure that just ain't true. And if everybody's model got to that same answer and it was flawed, it doesn't work. And so I think that's a risk with AI. And so we're always going to have human supervision at least over our portfolios.
I agree.
I wanted to ask, something that most people don't know about me is I'm very green, like super green.
Right.
My exterminator is green. I use green products in my house. I really do care about the environment. Two things that I'm really interested in right now, Kerby, and maybe there's some investment opportunities in this area. One of them is grounding. I have a grounding mat under my desk right now, my feet on, and I have a grounding mat on my bed. I'm grounding most of the time if I can. And for those that don't know what that is, go to Google and look it up.
Yeah, I will.
The other thing is I just watched a documentary on Netflix about microplastics. Because I'm really into this whole health and wellness thing as well. And I'm changing out a lot of the things in my house, like my cutting board is now stainless steel. The bowl that my dog drinks out of is now stainless steel. But a lot of us have microplastics. I'm not using plastic bottle water anymore. A lot of us have microplastics inside of us right now. And so I'm really starting to research that a lot. And part of the documentary was talking about fabric. A lot of fabrics are made out of plastic, nylon, polyester, etc. Even the coloring. And now there are a lot of places that are bringing out things that are plant-based. Even they were talking about before, this is generation, decades ago. A lot of the materials were more plant-based, like cotton, but then things became petroleum-based. Right. And so that's where a lot of our microplastics are coming from. We're wearing it. We're wearing it. We're eating out of it. We're sticking it in the microwave. We're doing all these things. I could see this. I'm sure that there's some components of this that are part of ESG investing right now, but are you starting to see some things on the radar about reversing microplastics?
We are. And it's interesting that you say that. In fact, I had read the study too that, and I thought I was being environmentally conscious by reusing my Aquafina water bottle or and it turns out I'm just drinking plastic after, and somebody said, you see the expiration date on a water bottle. they're like, well, water doesn't expire. It's the bottle, dummy. That, yeah. So yeah, I've got the, the metal water bottle as well. I think that movement is maybe in its, I wouldn't say infancy, but it's more of a toddler at least now. And so it'll probably take some time for that to work through. Unfortunately, corporations are driven by the quarterly profits, right? And the margins, right? So if this is more expensive, well, they're going to resist it until an ESG or your generation, Sarah, says, hey, enough is enough. I'm not going to buy these bottled waters anymore. So yeah, I think that's one of the movements that we're looking at. That now, I will admit, grounding was new. I wasn't familiar with that, but I'm certainly going to dig into it, this afternoon. Yeah, and if you can get, so here's the thing that you'll find investors will do. They'll buy into this theme like that, right? And we can figure out, okay, here's the companies that will benefit from that. And if you're far enough in advance of everybody else recognizing that, if you're too far, you're going to lose interest, right? You just sit and the market doesn't recognize and reward the stock price of that company. And so you may have to be willing to say, all right, I might underperform for a little bit, but I'm still believing in this process and in this company. And crosswinds happen, as we've talked about right now. The clean energy and the environmental investing is getting a lot of blowback right now. It's just, whether it's the administration or whatever, sometimes being early and having those outside forces impact your investment, you don't get rewarded as quickly as maybe you should, and as quickly as you'd like to. But having said that, though, once that gets traction, you're off to the races, right?
Well, one of the reasons why I watched this documentary is because it was really focused more on fertility, because fertility rates are significantly down because of microplastics, and they basically had these on there that kind of went through a purging, if you will, because they were all trying to get pregnant, and they all got pregnant. They started showing the data that we could be extinct if we don't address this.
Really?
But when fertility rates drop significantly, now you're talking about population shifting, and over a period of time, kind of like the dinosaurs, like we could not. So I thought that was pretty interesting.
That
is
just
as a side.
Yeah, I've got to check that documentary out.
Look at it. It's on Netflix. It just came on maybe about a week ago.
Okay.
But we are at the end of our time, Kerby, and I know Sarah and I have both so enjoyed having you here. We've learned so much. I've even learned more about you, and I've known you for 6 years now.
Right.
I do have a closing question for you. If you could leave investors with one takeaway about long-term investing, what would that be?
I think it's a twofold takeaway. One is, again, risk and return go hand in hand, right? There's just no way around that. But the other message that if I could get out there to as many young people as I can, it's start early and stick with it, right? Even if it's just, I don't care, $50 a month or a $200, whatever it is. The trick is stick with it and let that magic of compounding work for you. Being at the, I'm closer to 60 than I am to 50 now. And so I don't have the time frame that the 25s and the 30-year-olds do. But I mean, so there's a rule in math that's the rule of 72. You take your return, divide it into the number 72, and that tells you how often your money or how long it takes your money to double, right? And most kids will show, or young people will show them when your money doubles and doubles and doubles and doubles, it adds up. So make it automatic. Make it before you spend, because if you try and invest what's left, there's nothing left, right?
Yeah.
So do it first and do it automatic. That's my wisdom.
Awesome.
That's great. Great wisdom.
So much for that. We so appreciate it, Kerby. This live will be on our YouTube channel. I'll probably also add it to my website where you are posted. I'll say, hey, get to know Kerby. This is great information, and I just wanted to thank you so much for this. And of course, we'll have Tom on here at some point as well.
That'd be good.
Sarah, do you have any closing words you'd like to say?
Just thank you so much for being our first guest on our webinar series, Kerby.
Thanks. I'm honored. I really am. It's a privilege.
I really appreciate it. And
as well.
Sounds good.
Awesome.
Yeah, I'm still waiting for my investor swag, by the way.
It's coming. So, it's coming.
It's coming. All right. XL. There you go. All right.
All right.
Well, thank you very much, you guys. I enjoyed it.
Thanks our viewers much. And wish you all prosperity in the future.
Thank you all for watching.